Welcome back to the Deep Dive. Today, we're sort of cracking open the report card for a major player, Morgan Stanley. We're looking at excerpts from their 2019 shareholder letter, which is reflecting back on their 2018 performance. A standout year, apparently.
Yeah, definitely a big year for them.
But we're not just reading out numbers. Our sources give us a glimpse, into how they hit those records, but also their long-term game plan, how they want to make that success last.
Right, the strategy behind it.
Exactly. So our mission here is to uncover that specific strategic shift they made. They called it their dual mission, I think.
That's the term they used, yeah.
Try and understand how that let them hit highs, but also kind of secure the future.
Okay, so let's unpack this.
And you have to start with the big headline. 2018 was, well, an all-time record year for them.
Okay.
All-time highs across the board. Revenues, pre-tax profit, net income, and crucially, firm-wide net revenues actually broke $40 billion.
Wow. $40 billion. Huge number. And this was, even though, as the letter points out, there was a definite market slowdown, a softening in the fourth quarter of that year.
$40 billion.
Yeah.
Yeah, that's a number that commands respect. But like you said, it wasn't just about that one big number for the year. It was about building something more lasting.
Precisely. And what's really interesting is how they got those records. It was this focus on the dual mission you mentioned.
Right.
Driving earnings growth aggressively, yes, but also really enhancing the stability of those earnings.
Ah, okay. So not just higher, but steadier.
Exactly. It wasn't just hitting a peak. It was about, let's say, composing a sustainable symphony. They clearly recognized that the super volatile trading revenues from before.
Yeah. Well, they made long-term planning difficult.
Okay, so stability becomes the strategic anchor.
Yeah.
But, for anyone watching the markets, big bank revenue usually feels pretty volatile. It goes up and down with the market, right?
It often does, yeah.
So how did they actually, engineer the stability into the firm itself? Well, the main way was this huge restructuring project, really over the previous decade.
Okay.
Successfully building out these complementary, less volatile franchises. Think institutional securities, wealth management, and investment management. These pillars allowed them to diversify, to not rely just on the trading floor swings. And the key number, the metric that shows it worked. In 2018, well over half, significantly over half of their firm-wide revenues came from these relatively stable sources.
Okay, let's pause there. Relatively stable sources.
Right.
What does that actually mean in practice for someone listening? What kind of business are we talking about?
It really boils down to predictable fees. So think asset management revenues. Those are usually a percentage of the assets they manage.
Right, AUM fees.
Exactly. Then you've got revenues from financing, secured lending, things like that. And also investment banking advisory services, M&A advice, for example, which often carry flat fees.
Got it. So less tied to the daily market roller coaster.
Precisely. These parts of the business operate more on fee-based arrangements, so they're just generally more shielded from those big daily swings you see in pure sales and trading. That's the blueprint, really, for repeatable success.
Makes sense.
And overall, it worked out. They hit their stated goal range for return on equity, ROE, landing at 11.5%.
That structural shift is, well, it's pretty smart because it gives them the foundation to take risks where they need to compete, like in traditional banking.
Right.
So the foundation's set. Now, how did they juice the growth side? Let's talk about the heavy hitters, starting with institutional securities. That's the classic high-octane investment bank part.
Yeah, and they maintained serious market leadership there. Their investment banking division pulled in over $6 billion in revenues.
Wow.
And they consistently rank, top 2 in the global league tables for advising on M&A and underwriting IPOs.
So the big deals.
The biggest deals, if you look at their specific wins in 2018, #1 advisor on global completed M&A, #1 underwriter of global equity offerings and IPOs, that's just clear market dominance in their traditional strength.
And the trading side obviously performed well too, even with that Q4 crunch you mentioned.
Oh, absolutely. Equity sales and trading was a monster, nearly $9 billion in revenues.
$9 billion.
And they finished #1 globally in reported net revenues for the 5th year straight, capturing a 20.7% wallet share.
Okay, hold on. 20.7% wallet share. For listeners maybe not deep in trading metrics, what does that percentage really tell us about how dominant they are?
It tells you they are the undisputed leader by a, frankly, huge margin. Wallet share is basically the slice of the total fee pie they captured in that specific market.
Right. The total pot of money available.
Exactly. And for a market as massive and competitive as global equity trading, taking over a fifth of all the revenue available. I mean, that means they're probably doubling, maybe even tripling the revenue of many close competitors.
That's incredible.
It's not just winning, it's almost monopolizing that top spot. And even fixed income sales and trading, which, let's be honest, has been a tough area for the whole industry. Even that held strong. $5 billion in revenues, described as a credible and critically sized business.
So that's the high growth, maybe higher risk engine. But that trading volatility is exactly why the other part of that dual mission, stability, is so vital. It's what lets them handle that risk. Which brings us back to their anchor, wealth management. How big, how stable is that part of the operation?
Wealth management is, it's the ballast for the whole ship. It reported over $17 billion in revenue.
$17 billion.
And crucially, it hit a pre-tax margin of 26.2%.
Okay, define pre-tax margin for us quickly.
It's essentially the profit they make before taxes relative to the revenue they bring in. And hitting 26.2% put them right in the middle of their own target range, which was 26% to 28%.
That margin seems incredibly high for financial services. It really speaks to how efficient that business is and maybe how sticky the clients are. They're managing $2.3 trillion in client assets, you said.
$2.3 trillion. Yeah, the scale is just staggering. You're basically managing the entire annual GDP of like a G7 country.
Wow.
And it's not just trust, it's also lock-in. And their long-term strategy here really leans into where they see things going.
Which is?
They expect the industry trend to continue assets moving more towards advisory, fee-based services, and away from old-school commissions.
Makes sense. More predictable for the firm.
Exactly. So to really capitalize on that, they've invested a lot in technology. The goal is to give clients a really compelling reason to consolidate all their assets with Morgan Stanley, maximizing that fee-based revenue stream.
So if the investment bank is the powerful, maybe flashy engine, wealth management is this super profitable, steady fuselage keeping everything airborne.
That's a good way to put it.
Okay, let's look ahead then. How are they investing for the future? Geographically and through acquisitions?
Geographically, the big bet is clearly Asia. The sources explicitly say they expect Asia to play a much bigger role in global growth over the next decade or so. So their expansion plans are really designed to tap into the wealth creation happening there, especially as capital markets become more important for financing in the region.
And they also have that specific advantage in Japan, right? Third largest economy globally.
Absolutely. That unique partnership they have with MUFG, the big Japanese bank,
right?
It gives them the second largest market share in Japan among all players, and they actually surpass all the other foreign competitors there. That kind of deep, established local partnership creates a significant competitive moat. It really helps protect their global expansion goals.
Okay, shifting gears to acquisitions, inorganic growth. The sources seem to suggest a very specific philosophy now. They contrast it with the huge Smith-Barney deal from about a decade prior.
Yes, and the clarity of their thinking here is quite striking. They basically position Smith-Barney as the big exception that was a deal that fundamentally reshaped their whole operating model.
Right, a transformational deal.
Exactly. But today, their focus is different. It's all about bolt-on acquisitions.
Define a bolt-on for us. How's that different from just buying another company?
A bolt-on is usually smaller, much more strategic. It's designed not to change the core business, but to fill a very specific gap they've identified.
What kind of gap?
Could be a product they don't offer, maybe some specific talent they need, or geographic reach in a niche area. Think of it like adding a specialized wrench to an already well-stocked toolbox, rather than trying to build a whole new toolbox.
Okay. Keeps them focused.
Right. It lets them compete better in certain spots without messing up their overall strategic direction or taking on massive integration risk.
Can you give an example or two? Those recent bolt-ons and the gaps they filled?
Sure. Mesa West Capital LLC was one. That added a real estate credit platform to their investment management arm, filling a product gap there.
Okay.
And maybe even more strategically important was acquiring Solium Capital Inc. That expanded their workplace solutions offering within wealth management.
Solium.
Yeah.
Right. Why is boosting workplace solutions so strategic? What's the angle there?
Because it's all about locking in the next generation of clients. Workplace solutions, things like managing company stock plans, give the firm direct access to younger employees, emerging investors, people who might not have huge wealth yet, but are on track to be the wealthy clients of tomorrow.
That's smart. Future-proofing that big wealth management engine.
It's a really clever move to keep that pipeline full for decades to come.
And this proactive approach, this strategy,
Mm.
it clearly needs to translate into returns for shareholders. How did that look in 2018?
Oh, it definitely translated. They returned a massive $6.8 billion in total capital to shareholders just in 2018.
$6.8 billion. Okay.
But the forward-looking statement is maybe even more revealing. They stated a clear goal, an aim, of returning excess capital with a target of a 100% payout ratio. Now, that's subject to regulatory approval, of course.
A 100% payout ratio target.
Yeah.
That sounds extreme. For listeners not steeped in finance, what does that practically mean?
It means they intend to give back every single dollar of earnings to shareholders that they don't absolutely need to keep for running the business day-to-day or meeting regulatory capital requirements.
So basically giving back almost everything they earn.
Pretty much. They're essentially signaling, look, our business model is now so efficient, so predictable, so stable, we don't need to hoard huge amounts of capital for unexpected shocks or massive future projects anymore. We can give it back to you, the owners.
That signals incredible confidence in this new, more stable revenue mix they've built.
Extreme confidence.
Yeah, but that confidence, as the letter points out, isn't just built on spreadsheets and financial models. They make a really strong case that the long-term guarantee isn't just the strategy or the numbers. It's something, well, less tangible. Culture.
Yes. And here's where it gets, I think, really interesting.
Yeah, I was surprised how much space they gave this in what's basically a financial report focused on ROE.
They make this critical distinction, a robust strategy that ensures success at any given point in time. Okay, fine. But a strong culture, that's what ensures enduring success, success over decades. They really position this as the ultimate differentiator. What separates them from the pack isn't just the model, it's the internal focus, the human element.
So culture isn't just like an HR buzzword for them. It's framed as fundamental to generating long-term shareholder value.
Absolutely.
What are the core values they talk about?
They list four main ones that they say guide everything. First, put clients first. Second, lead with exceptional ideas. Third, do the right thing ethics. And fourth, give back community involvement.
Like a standard-sounding values, perhaps.
Maybe, but they stress it's not just a poster on the wall. They talk about embedding these values through things like annual culture conversations with all employees,
Right.
integrating them directly into performance reviews, and hammering it home during new employee onboarding. They're trying to make it operational.
You mentioned diversity and inclusion earlier, but the source material used a specific word I noted, belonging. Why emphasize belonging?
Yeah, that's a subtle but important distinction. It feels like a more modern, maybe deeper definition of inclusion.
How so?
Well, their commitment seems to go beyond just hitting diversity numbers, increasing representation, which is the measurable part. They're aiming for belonging, making sure every single employee, regardless of background, feels genuinely valued, respected, like they can bring their whole self to work. It fosters psychological safety, engagement.
And presumably that translates into better retention, better ideas.
And a stronger pipeline.
Yeah.
Exactly. They actually noted measurable results from this focus.
That's jazzy.
An increased proportion of women and multicultural candidates getting promoted in their latest managing director class. They also held their first ever global conference specifically for women managing directors. It shows they're investing in building that diverse leadership depth.
And that depth and experience seem reflected right at the very top as well.
Oh, for sure. They point out they have an exceptionally experienced senior team. The average tenure on their main operating committee, 23 years.
Wow.
And on their broader management committee, it averages 19 years. That kind of stability and collective experience at the leadership level, it provides remarkable consistency in actually executing that dual mission strategy over the long haul across different market cycles.
Okay, so if we try to boil this down, synthesize this deep dive into their 2018 performance and strategy. For you, the listener, the key takeaway seems to be this. Yes, success was driven by that continued dominance in institutional securities, the big M&A deals, the IPOs.
The traditional strengths.
But the whole operation was made much more resilient, much more stable by that crucial strategic pivot towards reliable fee-based revenues, especially in wealth management.
Right. They deliberately engineered the business to be less dependent on the market's daily mood swings.
The numbers from 2018 showed the strategy worked in the short term. Record profits, hitting targets.
Exactly. But the deeper insight, I think, is their explicit belief, the bet they're making, that it's their internal focus. Investing in culture, in talent, in those core values. That's the only real way to guarantee those kinds of superior returns consistently over decades.
Banking on internal strength to navigate external storms.
That's the idea.
Okay, let's wrap up by connecting that strategic confidence directly back to capital allocation. The sources highlight that well over half of their revenues now come from those stable, predictable fee-based streams.
Yeah, the non-volatile stuff.
And they're aiming, as a future goal, for a 100% capital payout ratio. So here's a final thought for you to chew on. If a giant global bank feels that confident in the predictability of its income that it plans to return essentially all excess profit to shareholders, what does that confidence imply about the level of risk they now perceive in their own restructured operating model?
Good question.
Are they signaling that the era of needing massive capital cushions just to survive potential trading blow-ups, is that truly behind them? That's something to think about.